So CFPB, rest in peace. Gosh. So I'm
Can you
talking here
believe
today.
that?
I'm talking here with Owen Lee. Um, you know, I don't know what to think about it, which I'm glad you're here to kind of clear the air a little bit. And you know,
Hmm.
as you mentioned here in the green room, things are moving so fast. I'm gonna have to publish this episode like today, if at all possible, because otherwise,
Yeah.
if we wait 24 hours, what we say here might not
Might
even
not be
apply.
current. Yeah, might not be
Yeah.
current.
So if somebody's
Uh,
brand new, just
yes,
what
sir.
what is the CFPB, and kind of bring us up to date on what's going on.
Sure. So the CFPB is the acronym for the Consumer Financial Protection Bureau. It was the brainchild of Senator Elizabeth Warren and a few others who were the primary writers of the Dodd-Frank Financial Reform Act, which came in 2009 after the financial market crash. And the idea was to create this bureau that was going to examine all different kinds of financial companies, not just mortgages, although we're probably the biggest segment, but auto lenders and credit card companies and, you know, payday lenders and pawnbrokers and all kinds of stuff. And, you know, they're insulated by the way that they're funded, and they don't get regular appropriations from Congress like other agencies do, like the FBI or something like that. And they've just kind of gone a bit wild. There's a lot of people that, especially, again, not being Republican or Democratic, but I think we all know that Republicans generally favor less regulation. Democrats generally favor a bit more regulation. And some of the directors that we've had, like Richard Cordray or Rohit Chopra, you know, Rohit Chopra used to post on X and, you know, about things that he wanted that weren't not rules. And like he called credit report fees junk fees very famously after the State of the Union. And the industry went crazy because the federal government, like the federal Fannie Mae and Freddie Mac are in conservatorship. You cannot close a Fannie Mae or Freddie Mac loan without a tri-merge credit report. We all know credit report fees are going up, and we have a legal right to pass that charge on to the borrower. And he's calling it a junk fee. And it just created all kinds of problems. So they're not super popular folks within the industry, and they're in the crosshairs right now, that's for sure.
Yeah, we saw a thing Elon Musk
Yeah,
posted, which again, this might be outdated as the time we hit publish here, likely this
that's
afternoon.
right.
And you know what? Let me timestamp this. So we're as we're recording this, it's Thursday morning, February 13th, and
That's
so
right.
I'm gonna try to get this out like this afternoon or at the latest on Valentine's Day. Uh, so Elon posted CFPB rest in peace
On Saturday. Yep.
on Saturday, and so what will that is that so my initial gut reaction when I heard that, because I think you texted that out to me. You were in Hawaii actually
Yes,
with the lovely Mrs. Lee, and if
that's
I
right.
remember right, you texted to me or something on a Saturday morning or something like that. Hey, did you just see this thing that Elon posted?
Oh,
Right?
my phone started going crazy. Yeah,
Yeah.
yeah.
So my original thing was I was kicking my heels up. You know that the CFPB has been a thorn on our side. Is it
Hmm.
all good? Like so if they go away, what does that mean to us? And let's talk about the pros and, if there are any, the cons.
Right, right. So, look, I get everybody's gut emotional reaction. Most of the people in the mortgage industry, yeah, CFPB, I wish they could go away. But we got to take a look at this as the Washington, D.C. folks take a look at this, and as because we're going to be governed by their rules. So let's just do a reset real quick. Congress created the CFPB So if anybody's going to quote unquote kill it or wipe it or send it to its grave, like Elon Musk posted on X, then it's got to be shut down permanently by Congress. And that's very unlikely to happen. There are not 60 votes in the United States Senate to shut down the CFPB. So that's likely not going to happen. Probably the most drastic thing the Trump administration could do is to starve it of funds, refuse the funding that it gets from the Federal Reserve, shut it temporarily down, or reduce the staff level to literally nothing or almost nothing, so they can't enforce, right? And then you would get a 3.5-year holiday from CFPB enforcement. But here's the problem with that, right? As soon as a man or a woman of different ilk occupies 1600 Pennsylvania Avenue, whether that's in 2028 or 2032 or whatever, all those rules, like we have a lot of bad rules right now that are onerous and cause us to, that conflict with other rules and cause us to have to do things that really don't add much to the integrity or in the investment quality of a loan, don't protect the borrower. If we could get out from under some of these rules, we could deliver quicker, faster, and cheaper to the borrower. We need cheaper right now. I think everybody in Washington, D.C. would agree with that. But if the CFPB just essentially gets starved to death, all those rules stay in place. There's a legal rule-making process. So if they get starved to death and none of the rules change, well, as soon as the new sheriff comes into town and decides to revive the CFPB, they can go out and prosecute any member of the industry for violating those rules, because those rules have a 3 or a 5 or a 7 or a 10-year statute of limitations. And so what's really best for the industry is a smaller, friendlier, slimmed down CFPB that over the next year or two goes through the legal rulemaking process to change the rules. That's how we're going to get the most relief. It's not, you know, as much as you have that guttural, emotional, visceral reaction, CFPB RIP is not the best way to go. Maybe the best way to go, if you really, really don't want the CFPB, is let's change the rules and then CFPB RIP. Because otherwise we're just going to have a legal mess, and I promise you the large loan buyers will want the rules followed. So if all they do is starve it to death over the next 3 years, or starve it to almost death would be most accurate, the people that thought, you know, we're not going to get that much relief, not nearly as much as people say or think.
Hey there. Hey, if you're loving the tips so far, be sure to hit that subscribe button right down there and then tap the little bell so that you never miss out on more free, cool tips coming your way. Also, I would love to hear from you. Drop a comment beneath there. Let me know what you think, or tell me what you'd like to hear next. Because the rules would still be in place. They just couldn't
That's right.
afford to have the sheriff going around and locking people up, per se, enforcing the rules. But when the new
That's
sheriff
right.
comes in town, if and when, and they say, hey, we want more regulation, we want to enforce this, they could go back for the last 4 years and prosecute anybody that didn't follow these rules. And again, you and I are not
Absolutely.
suggesting, you know, people go out and act like loan officers. Look, the CFPB, and you know this better than I do, Owen, but my suspicion is it was meant for good, right? That's my suspicion. It was meant for good. And
I agree.
in any kind of consumer protection, frankly, it is good, right? It is good. It's just it's like the line was drawn. This is the rules and this is not. This is okay and this is not. And it seems like they kept pushing that line further and further about what's not good, and overstepping the rules. What I'm kind of hearing you say.
That's right. Well, like a lot of things in Washington, D.C., and again, not being political, but these agencies get started with oftentimes a good intention or a good purpose. And then over the next 1, 2, 3 decades, they get far away from that original intended purpose, and they get larger and they get ingrained. And, and I think that there's an argument to be made that that's what's happened with the CFPB.
Yeah. So is there any, so what I'm hearing you say is the big con for us is if they're going to make it go away, they need to make it go away and not just starve the fundings, because if they starve the fundings, it really doesn't solve any problems. It just delays the problems. And frankly, 3-4 years from now, it could make the problem even worse because it'd be a backlog of
Yeah.
issues.
Well, it's interesting, Carl. You alluded to it. I was in Hawaii for a few days. I had to be on the West Coast for twice for the MBA in a short period of time. So I was able to go wester, and I know that's not a word, but for a few days. But I'm just coming back from the MBA convention, the commercial multifamily convention in San Diego for 3 days, and that's all we were talking about is wanting to get the rules changed before there might be some kind of permanent or drastic change at the CFPB. Because if we don't get those rules changed, a lot of the first enforcements under Director Chopra in 2021 and 2022, when the CFPB kind of came back to life after Trump 1.0, were them enforcing things that were done while Trump was in office, Trump 1.0, when people were thinking the rules were lightened. Well, those rules were still in place. If you have temporary suspension of enforcement, when that suspension of enforcement is lifted, you're still on the hook. So, we really need to work hard as an industry to get these rules changed. We need everybody who's going to listen to this podcast to join the Mortgage Action Alliance. If you think you're a member of the Mortgage Action Alliance, that's the MBA's grassroots advocacy. It's completely free. Just Google Mortgage Action Alliance. Sign up is easy. But you have to sign up every 12 months. So if you signed up 15 months ago and you think you're a member, it's just the way Washington, D.C. rules are. You got to re-sign up every 12 months. So it's we need to pay attention. We need to show up, and we need to make our voices heard, because I've been in this industry 22 years. I've never seen things change this fast.
Yeah, it's been impressive. Whether you think it's impressive good or impressive bad, it's definitely been impressive, the speed at which things are gone. Hey, so
That's right.
So is there anything, like, as the loan officer, branch manager, district manager that might be listening to this podcast today, is there any, like, if they starve this thing of the funding, is there any change that we're likely to see on the grassroots level, down in the trenches, closing loans every day? Is there anything that we might see that would change, or is this really not something that's going to directly affect us?
Well, the industry has a list of asks, and the number one ask is a revision of the LO comp rule. Revision of the LO comp rule under 3 circumstances. 1, to be able to have loan officers make less money to make it more advantageous for everybody to do bond loans, both state bond loans, county bond loans, for low-income borrowers. And then there's asks around if a mistake is made on a loan, and just generally the ability to, quote unquote, go lower in a competitive situation. We got really close to getting that rule across the finish line with Director Kraninger in late 2019 and early 2020, and then COVID hit, which essentially shut many parts of the government and the CFPB down. And then we had an election, and Kraninger was out. And so that rule never got across the finish line. So that's at the top of the list for the Mortgage Bankers Association, and probably the one that you might see action on the most. And then there's a host of others. So, but that's the one that might get across the finish line the soonest, that will be immediately obvious to loan officers and branch managers, and I think put us in a position to help us write more loans.
Yeah, I thought when they did all the loan officer compensation, while meaning to be good, I really believe that, like, it meaning to be good, it really put a pair of handcuffs on us instead of, so everybody went to the highest common denominator. And,
That's right.
and frankly, I think it hurt the consumer on pricing because, it kept us from getting skinny, when we need to get skinny, as any car dealership or as any refrigerator salesman or any drape salesman or any carpet salesman or any builder, when they want to be, or any real estate agent, that to have that flexibility, that's what drives the free market. So anyway.
Well, frankly, I hear a lot of people say just wipe the rule, and I think there's a lot of merit to that conversation. I just don't know if we're there yet. We have a new director who's nominated, McKernan, and we need to get him across the finish line and get him in that job to see whether or not that's a conversation he's willing to have.
Very good. Well, and real good. I think we kind of covered the basics of it. Again, we could go deep down many of these rabbit holes, and I'm sure there's going to be new updated information. So if I see something on X that catches my eye, I'm gonna text you and say, hey man,
we'll start texting. Yeah,
we need to delete the episode we did 30 minutes ago. We need a new episode. So
let's do it. Let's do it.
I appreciate all you do, brother, and you keep us updated on all this stuff and kind of clear the smoke out. And you're an awesome resource. I appreciate you, brother.
All right, take care, my friend.
All right, real good. Hey, I know a lot of you forward episodes to your loan officer friends, or maybe company wide in your company. Boy, this would be a good one to do because I know there's a lot of I hate to even use that word, but there's a lot of conflicting information on this, and this is the newest information as we have it right now. And so this would be a really good episode to forward. And if this was forwarded to you, make sure to subscribe, and we appreciate those reviews and suggestions on upcoming episodes. So forward, subscribe, and then review. So thanks again. We appreciate you, and we'll see you on the next episode of Loan Officer Freedom.